You walk into a coffee shop and overhear a loud argument at the next table. One friend swears by index funds as the slow and steady path to wealth. Another brags about mutual fund managers who pick winners. A third quietly mentions a hedge fund that turned $10 million into $50 million overnight, while someone scrolls an ETF screener looking for the next hot sector. You sit down, order your coffee, and a stranger tosses you a coin. Pick one. Which fund makes you rich? The coin flips through the air and lands on the table. This is where most investors start, dazzled by headlines, confused by names, and terrified of making the wrong choice. In this video, we'll demystify the four fund types that everyone talks about: index funds, mutual funds, hedge funds, and ETFs, and show you how each one really works, who they're for, and what you're actually paying for. You'll leave knowing which type of fund fits your goals and risk appetite, not the latest marketing slogan. Imagine a fund as a basket at a market. Instead of buying a single apple, one stock, you buy a basket containing apples, oranges, and bananas, many stocks and bonds. A fund pools money from many investors to buy that diversified basket, so individual risk is reduced and access to a larger portfolio becomes possible. Funds are run either passively by rules that replicate an index or actively by managers who handpick investments. The important mechanics to understand are pooling, many investors contribute; professional management, someone runs the basket; diversification, spreading risk across many holdings; and fees, the cost paid for management and administration. That combination, structure plus cost, is what differentiates index funds, mutual funds, hedge funds, and ETFs, and sets expectations for returns, tax consequences, and liquidity. Index funds are built to follow a market index like the S&P 500 as closely as possible. There's no stock-picking heroics. The fund simply owns the same companies and weights as the index. That means lower operational complexity, fewer trades, and significantly lower fees compared with active strategies. Over long periods, this passive approach tends to match market returns and avoid the consistent underperformance that many active managers experience once fees are included. For most individual investors focused on long-term wealth accumulation, retirement, major financial goals, or simply compounding returns, index funds offer a highly efficient, low-cost way to capture broad market growth without the stress of timing or stock selection. The trade-off is, you won't beat the market, you'll ride it for better or worse. Mutual funds typically employ active managers who try to outperform the market by picking stocks or timing sectors. That human element can add value when managers make smart decisions, but it also introduces two costs: higher management fees and the risk of inconsistent performance. Mutual funds come in many flavors: actively managed equity funds, bond funds, balanced funds, and often charge front-end or back-end loads, plus ongoing expense ratios. Because managers buy and sell based on judgment, turnover can trigger taxable events for investors, which affects after-tax returns. Mutual funds are appealing to investors who want a managed solution and are willing to pay for the manager's expertise. But you must evaluate whether historical outperformance justifies the additional cost and tax drag compared with cheaper passive alternatives. Hedge funds operate in a different league. They use leverage, short selling, derivatives, and concentrated bets to pursue outsized returns and sometimes absolute return targets. They're usually open only to accredited or institutional investors, because of high minimums, limited liquidity, and complex strategies that can produce extreme volatility. Compensation structures are famously steep: performance fees plus management fees, and the operational opacity means investors often have limited visibility into positions and risks. Hedge funds can deliver exceptional returns in the hands of top talent, but they can also implode or produce catastrophic losses. They are not designed for the average buy-and-hold investor. They're designed for those who can absorb large swings, tolerate lockup periods, and evaluate sophisticated risk management processes before committing capital. Exchange-traded funds combine many benefits of index funds with the tradability of stocks. ETFs typically replicate an index but trade on an exchange throughout the day, letting investors buy and sell at live prices. They offer low expense ratios, intraday liquidity, and tax efficiency through creation-redemption mechanisms. ETFs come in passive index forms, active strategies, and niche thematic exposures, everything from broad market ETFs to sector, commodity, and leveraged ETFs. For DIY investors who want low-cost diversification with the ability to implement tactical allocations, ETFs are a powerful tool. The flexibility comes with the responsibility to understand bid-ask spreads, tracking error, and, for some specialty ETFs, added volatility or structural quirks that can affect returns during extreme market conditions. Picture 4 columns on a whiteboard: index funds, mutual funds, hedge funds, ETFs. Now draw 3 rows labeled fees, liquidity, risk. Index funds score low fees, high liquidity, and moderate market risk. Mutual funds show higher fees, daily liquidity, but possible tax inefficiency, and manager-dependent risk. Hedge funds light up as high fees, low liquidity lockups, and high strategy risk. ETFs sit near index funds on fees but offer stock-like intraday liquidity and sector-specific risk variability. This visual clarifies how structural features govern investor experience. Low fees compound into meaningful long-term advantages. Limited liquidity and opaque risk can magnify downside. Active management's value must exceed its cost to justify choosing it. Fees are the hidden erosion of returns. A difference of 0.5% or 1% per year looks small until compounded over decades, producing huge gaps in final wealth. Index funds and many ETFs typically charge fractional basis points, whereas mutual funds can charge higher ratios and hedge funds can take outsized shares of performance. Taxes are another stealth cost. High turnover in actively managed mutual funds can trigger taxable gains for holders, while ETFs generally provide tax advantages because of in-kind creation/redemption that reduces capital gains distributions. When assessing any fund, always look past headline returns and compare net of fee after-tax outcomes. That's where the real investor decision lies. Whether you're receiving value that exceeds the fees and tax consequences you accept. Match the fund to a clear persona. A 25-year-old starting a retirement account with limited time for research should favor index funds or broad ETFs that minimize fees and maximize market exposure. A busy professional seeking a hands-off, tax-efficient solution might choose an ETF or a no-load mutual fund with a solid track record. A wealthy, sophisticated investor with capital to lock up and a high risk tolerance might allocate a portion to hedge funds for diversification and potential alpha. If you're goal-driven, think first about time horizon, tax situation, risk tolerance, and the value you expect from active management before selecting a vehicle. Fund choice is an alignment exercise, not a popularity contest. Let's wrap with a simple filter. Start broad. What is a fund? Then narrow through 4 key checkpoints: fees, liquidity, tax impact, and management style. By the end, you're not chasing hype, you're choosing fit. For most long-term investors, index funds and ETFs offer the best balance of cost, access, and simplicity. Mutual funds and hedge funds, they serve niche roles, but only if the fees and complexity match your goals. So here's your next move. Grab your current portfolio, run it through this filter and ask, does this fund serve me or sell me? If it doesn't align, it's time to reallocate.